Remember to bring your packet too. You still have time, 1 minute, you can still download it. That's the advantage of digital packets, right? There's actually a packet 3. It's kind of scary thought. We have 11 sessions left and 2 more packets to get through, right? Okay, folks, let's get started. I hope you had a chance to pick up your quiz. If not, it's still up there. So try to pick it up as soon as you can so you can at least check the grading, make sure I haven't messed up. So today we're going to change gears. We're going to actually talk about pricing things rather than valuing. So as a lead-in, let's start with a question. And in fact, I'm going to start by noting that almost everything that you see out there that passes as valuation is really a pricing in disguise. People like to price things, whether they use multiples and comparables or whether they use some other metric. Basically, people like to price things. And one of the reasons I've heard from analysts as to why they prefer to price stocks rather than do intrinsic valuation is their argument is you need to make less assumptions. And let me ask you, let's start with the easy question. When you had to value a company, did you have to make assumptions? Absolutely, about growth and margins and reinvestment and risk. Was it a pain in the neck? Absolutely. So much work, right? You got to understand the business and the competition. So the argument they make is when I use a PE ratio or an EV to EBITDA, I don't have to do any of that stuff. Technically, the answer, yeah, that's true, right? But one of the things we're going to talk about in the context of pricing is that really true? Are you not making assumptions? Or is the truth a little more difficult to get to? What exactly is happening when you're doing pricing? You're not making explicit assumptions, right? Are you making implicit assumptions? Absolutely. You never state them, and that's part of the problem. So when you compare your company to the average PE ratio for the sector, you are making implicit assumptions about your company. Could they be wrong? Absolutely. And in fact, we're going to talk about some of the things that can cause your company to have a PE ratio very different from the average and still be not mispriced, in fact, priced right. The second thing I'm going to talk about today is statistics. And you're going to see the shift again. I mean, we really haven't done much statistics through intrinsic valuation. But I'm going to argue that the skill set you need to deal with pricing is actually statistics. Because what's statistics designed to do? What's the objective of the discipline? What are we trying to do in statistics? Trying to make sense of large and contradictory data. Both pieces have to, if you had just 5 observations, you don't need statistics. You could eyeball the data. If the data all points in the same direction, you don't need statistics. The data it's when the data is pulling in different directions and it's too difficult for you to get your eyeballs around, statistics comes in useful. If I taught a statistics, and thank God I don't have to, I'd use entirely financial market data to illustrate it because it's perfect. This was big data before big data was even invented. Financial markets were the original places with huge amounts of data pulling in different directions. And one of the things we talk about in statistics is distributions, right? So let's suppose I took the PE ratio for every company in a market. You can take whichever market you want. And I drew a histogram. Remember histograms and statistics, you count the number of companies, PE ratio 0 to 4, 4 to 8, 8 to 12, and I put up a distribution. Will that distribution ever look like that distribution we so love in statistics classes? The normal distribution. In fact, let's step back. What is it that's so nice about the normal distribution statistics? Why, when you see a normal distribution, should you celebrate? What makes it easy to work with? I'm sorry, what?
Symmetry.
Symmetry, but what does the symmetry give us? You can describe a normal distribution with
average,
two parameters, right? The mean and the standard deviation. Whereas if you take more complex distributions, I have to give you the mean, the standard deviation, the skewness. I mean, there are all these other things to control for. Makes life a lot simpler if you have a normal distribution. Can a P ratio have a normal distribution? Remember a normal distribution, what are the limits on a normal distribution? You go to the tails. Minus infinity to plus infinity, right? The tails get really thin at the end. What's the lowest number of P ratio you can take? Have you ever seen a negative P ratio? No, you don't. You know why? Because when the earnings turn negative, the P ratio becomes not meaningful. So the lowest value of P ratio can have is 0. What's the highest value of P ratio you can take? Today, I'm going to show you the P ratios for US companies at the start of 2023. You know the highest P ratio was? 86,400. You see, that must be one absurdly highly priced stock. It was like a $7.50 stock, but the earnings per share dropped to a fraction of a cent. So the lowest value you can take is 0. There is no limit on the upper value, so you know already what the distribution is going to look like, right? It's going to have a right tail that stretches out. You think, who cares? This is inside statistics stuff. I don't know about you, but I remember what my statistics professor told me about these distributions. They're called asymmetric distributions. And he warned us, never trust the average when you have an asymmetric distribution. Why not? There's going to be a skew, right? Basically, all your outliers are big positive numbers. There's no big negative numbers to offset. The average is going to give you a number that's too high to describe the distribution. And I remember simplistic advice when you have a skew, asymmetric distribution, say, trust the median. It's a more meaningful number. I'm going to show you the difference between the average P for US stocks and the median P, and it's going to be shocking how big a difference there is. But the next time you're an analyst from CNBC say, this stock is cheap because it trades at less than the average P for the sector, you know what the anchor should really ask the analyst, right? What's the median? And I'll wager that the analyst doesn't know. If you don't know what the median is, you should be banned from ever talking about pricing because you've missed basic statistics. And finally, suppose you find a company that trades at a P ratio, software company, trading at a P ratio of 12. The average for the sector, or the median for the sector is 20. Let's suppose we're not playing the average here. The median for the sector is 20. And you're trying to make a judgment. So based on those numbers, what's the usual judgment? It looks cheap, right? But what else could explain why a stock could have a P ratio of 12? Let's start building the foundations, the kinds of questions you need to ask. Let's say I'm the person telling you this idea. Stock is cheap because its P ratio is less than the P ratio for the sector. And I give you a chance to ask me questions. What's the first question you're going to ask me? To try to figure out whether it's really cheap. Go with your fundamentals. What is the growth rate? And most of the time, what's the answer going to be? It's minus 5% a year and the sector is growing at 10, or it's 2% a year and the sector is growing at 20. So one reason could be that it has much lower growth than the growth of the sector, right? Second question, stay with it. How risky are you? You don't want cost of capital, it's cost of equity because it's a P ratio, but staying with it. How risky are you as a company? So even if you don't want to talk about cost of equities, and odds are that many companies that trade at low P ratios are there because they're much riskier companies. So growth matters, risk matters. It's the third and final question. We talked about growth. Not all growth is created equal, right? Some growth is better than others. And at least in the context of equity, what drives the value of growth? What kind of return in equity do you earn? If you're a company with a high return in equity, then you should earn. So You're going to ask me, what's my growth rate? What's my risk? What's my return on equity? And by the time I finish answering these three questions, you know what you're going to find, right? For every 100 companies that look cheap, you're going to find that 95 deserve to be cheap. There's some reason. But there might be those 2 or 3 companies where after you ask these 3 questions, you feel, okay, that's the problem with pricing, is not that people do it, but they're often too lazy to ask the questions you need to get answered before you decide something is cheap. And that's basically what we're going to do with every multiple, is come up with a list of, here are the questions you need to ask, whether it's PE or price to book or EV to EBITDA or EV to sales. Because if you can ask those questions, you can do pricing well. I don't have a problem with pricing, but I have a problem with sloppy pricing. So let's think about the drivers of pricing. So I'm going to go back to the last part of the first packet. Don't worry if you don't have it. There's like 7 pages because it lays the foundation for what's going to come. So everything we've done in this class, and this is 17th session, has been about coming up with intrinsic value, right? So if I asked you to summarize what drives intrinsic value, it's cash flows, growth, and risk. A discounted cash flow model might be the vehicle you use to deliver those assumptions, but it's cash flows, growth, and risk. What drives price? It's demand and supply. You're saying, aren't demand and supply driven by cash flows, growth, and risk? Yes, but they're also driven by mood and momentum. In fact, for the last 50 years in finance, behavioral finance has developed as an area to explain why people might price things that should not be in the value because of emotions, because of mood, because the crowd is doing it. There's a value process, there's the pricing process. The value process delivers value, the pricing process delivers price. Could there be a gap between the two numbers? Almost always. The question of what you think about the gap is what drives different schools of thought in investing. If you're a believer in efficient markets, you basically say, what gap? Because in efficient markets, if there's a gap, it quickly disappears. So even if it opens up, it's random and it disappears because in efficient markets, at least on average, the price and the value converge. So if you live in an efficient market, you shouldn't really be taking this class, the value public companies, right? The price is already out there. It's the best estimate of the value. And you might come to that conclusion after you valued a couple of companies and you might say, I'm making these assumptions. I have no idea what I'm doing. And you know what? That's a healthy conclusion. Think of how much money it's going to save you and how much time it's going to save you. You just buy index funds and you go back to living the rest of your life. Of course, your job might be valuing companies, but you don't have to believe in valuation to value companies. You just have to go through the motions. If you're a value extremist, you think, who's a value extremist? They show up in Omaha every year, once a year. They believe the whole world revolves around value. Value extremists think that the price process is always wrong. The value process is the right one. So what do? If something is undervalued, they buy it and they assume that because the pricing process is always wrong, that errors get corrected and they'll make mistakes. So there's not even a sense of doubt with value extremists. It's always value, pricing process. So they don't waste any time on pricing. They think it's a waste of time. And finally, there are pricing extremists. What are those? They're the ones that say, what is this intrinsic value you talk about? There's no such thing. It's in your head. My favorite show on CNBC to be on is Fast Money. It's a show that happens after the market closes. It's actually where they get 4 traders on the, and you've seen the show. It's basically these guys are traders. So the reason I like that show is there's no pretension there. They don't talk. So they whenever I show up, they say, what is this value thing you're talking about? Who cares? And I like that honesty because their view is value is this intellectual stuff you do, but pricing is demand and supply. We're traders. What do we care about? Buy at a low price, sell at a high price. If we do that with charts, great. If we do that with some other indicator, it's great. We do it with inside information, even better. But it's all about pricing. Who cares about value? What I'd like to at least set up as the process is to think about what each of these groups has its dilemma. The efficient market group is the only one that has no dilemmas. they're secure and Gene Farmer sleeps well at night saying, you know what, markets are almost always right. Why am I wasting my time? But let's say you're in the value camp, which presumably because you're taking this class, you believe there's at least a chance that you can use it. Let's think about the dilemmas you face in putting this into practice and actually making money out of it. The first is, you each valued a company, you sent your valuations. I said, okay, not okay, you know, whatever I said though. Are you uncertain about that value now? I hope so, because otherwise you got something wrong with you, right? Because you made a lot of assumptions to get there. Revenue growth, margins, reinvest. Of course you're uncertain about the value. So when somebody says, I know the value of the company, I don't think you can use the word no. I've estimated the value of the company, and there's a range around that value. So you're uncertain about value. It could be wrong. But what's the other piece of the puzzle? For you to make money, the price has to adjust to value. So even if you're right about value, the price has to. Are you uncertain about whether or when that will happen? You should be. Why? Because you don't control the market. Do you see the two uncertainties bubbling up to the surface? You're uncertain about your value, you're uncertain about price adjusting to value, which is one reason I diversify. Because I know I'm going to screw up in individual companies. Hopefully I don't screw up on all 50, because that's sending me a signal saying, why are you wasting your time doing this? Go back to buying an index fund. So whenever somebody says, I have a concentrated portfolio, you know, traditional value investors just buy 4 or 5 companies. 2 questions there. What makes you so sure about the value you have for each of the 5 companies? And what makes you so sure that the price will adjust to value? Because both have to be, you have to be pretty sure to say, I put all my bets on 4 or 5 companies. So if you're a believer in value, think about those things, because that price adjustment to value is out of your control. Of course, let's say you still believe in value. Say price will adjust to value. Here are the 2 pathways you can adopt on that price adjusting value. First is what I call the karmic view, which is, I've done my job, I've done all the homework, I've valued the company, the price is what it is, and it'll adjust, will not adjust. It's not in my control. The karmic view says, I don't control that, so worrying about it is not going to make it happen. Or you could try to find a catalyst that causes the correction. We talked about some of this. The catalyst could be, please God, let a Carl Icahn show up in the company that I just bought, because he can make the price move to value. Or you can look for other catalysts that cause. I think we mentioned right at the start of the class, the other catalyst could be a CEO passing on, a new management coming into play, the company itself hitting a trigger number. I'll give you an example. When I remember when Apple and Amazon both crossed $1 trillion in market cap. There's nothing special about 1,000 billion, right? Because 990, because in terms of numbers, there's nothing really, but there seems to be some magic we attach to the market crossing 40,000, 35,000. And from an intrinsic value standpoint, people say, who really cares? But I think we should, and here's why. When a company hits these arbitrary targets, more attention is paid to the company, right? Because it hits. And one of the arguments you can make is the reason that might matter to you is that might be the catalyst that causes the price correction. So maybe you think a stock is overvalued. And at $995, nobody notices, but it hits $1,000. And all of a sudden people look at it and say, you know what, we're paying 500 times revenues for this company. Maybe we're paying too much. So one of the things I think, if you're a believer in value, I'd like you to start thinking about is, what are some of the catalysts I would look for when I decide to buy a company? Take a look at all the data items S&P Capital IQ has on companies. In addition to all the financials, they actually also have the age of the CEO, the board of directors, they have an activism score. So a whole host of numbers you might use to decide where that correction is most likely. So I'll give away where I come from. I believe in value, but I also know I'm going to be wrong on value, and I don't control the pricing process. No, so if you get a chance, when you go back, I've been valuing Apple every year since 2009. I confess I'm biased towards Apple. It pushes up my value. But I've bought Apple 5 times in the last 14 years, and I've sold Apple 4 times. Again, it's back in my portfolio after a long, no. And it's a company that I think, has had pretty much the same story. The value has stayed pretty stable, but if you look across time, there's my value per share, different points in time, in the second column, the price per share. And you can see it goes from being undervalued to overvalued to undervalued to overvalued. And that's the way I think about markets. It's not that they are screwed up, but they overshoot and they undershoot. They overshoot and that's good. Because something that looks overvalued today could very well become undervalued, especially if it's the kind of company that's overvalued by 60%. It's overvalued by 60%. When it gets undervalued, doesn't stop at being 5% undervalued. It'll shoot in the other direction. So what makes it overvalued by large percentages is also going to make it undervalued. No. If you think about what we're trying to do here, it's to get to the comfort point where you're actually willing to put real money behind your buy or your sell. It's easy in the abstract to find something to be undervalued. It's difficult in practice to actually put your money in that company. And there's no easy pathway. You got to find that comfort zone. And that's basically what you're looking for when you look at the pricing process. So I'm going to close this section with a shot from one of my favorite movies. You know which one this is, right? Come on. The Wizard of Oz, the colorized version, or the recolorized version. I think they digitized the colors much better. You guys remember the story, The Wizard of Oz? I'll tell you the story. And as I tell you, don't jump on me because I don't make up these stories. It's about a girl called Dorothy who lives in Kansas. And a tornado sucks her up and drops her into this mythical land called Oz. You're saying this is so unrealistic. I'm not telling the story. This is the actual story of the Wizard of Oz. She lands on a witch. I don't know. I always get them mixed up, witch of the East or witch of the West, and she kills the witch. She's facing homicide charges. And she wants to get back to Kansas. So that's how the movie starts, with this tornado. So don't take your kid 10 minutes into the movie because the first 10 minutes are kind of traumatic. So she wants to get back to Kansas and she has no idea where to go. So she turns to this munchkin by the side of the road. And she says, I want to get to Kansas. Can you tell me how? And he says, I have no idea where Kansas is, but you should go ask the Wizard of Oz. He has the answer to every question that people have. He knows everything. He said, how do you get to the Wizard of Oz? He said, follow the yellow brick road. And for 3.5 hours, this is what she does. She hops and she skips and she never walks. If you don't believe me, watch the movie. She's always hopping and skipping down. And along the way, she collects a motley crew. A lion, which is cowardly, a scarecrow. And they all want something and they're all told, go see the Wizard of Oz. He has the answer to every question you might have. 3.5 hours later, and it's a really long movie. They arrive at the chambers of the wizard. They all walk in. And they all state what they want. So Dorothy says, I want to go back to Kansas. The cowardly lion says, I want courage. And the wizard says, come back tomorrow. This is like a government office. But they said, we've come 3.5 hours to the spot. And at that point, the curtain falls. The wizard is behind the curtain when he says, come back tomorrow. The curtain falls, wardrobe malfunction, I guess. And they see that there's no wizard. There's this guy with, hoist pulling things. And essentially, there's no Wizard of Oz. So what's this got to do with valuation? If you watch the movie, it turns out that each of them got what they were looking for on the journey. Dorothy found these red shoes, and all she had to do was click the shoes. She's back in Kansas. The cowardly lion fought off some bad guys, and along the way, he showed he had courage. Essentially, they learned everything they got what they wanted on the journey. You still don't see what's this got to do with valuation, right? In valuation, people are looking for somebody who has all the answers. That might be Google search or chat GPT, tell me what to do. And you're constantly searching. But the answer often lies in reasoning through the process. So when you're sitting there, what tax rate should I use on my earnings to get to cash flows? I mean, you can email me during the class and maybe I will tell you the answer, but you can reason your way to that answer, because if you think about what am I trying to do here? I'm trying to estimate what my total earnings will be and what I'd have to pay in taxes. Like the Wizard of Oz, you learn valuation on the journey. You learn valuation by doing. You learn valuation by getting stuck and unsticking yourself by reasoning your way to an answer. I wrote a piece for a teaching journal saying, the curse of Google search. You know why, right? Because when you have a question, now what's your first inclination? Let me go look it up on Google search. Somebody's come up with the answer. And 9 times out of 10, you're probably right. It saves you time because somebody else has already come up with the answer. But in the process, I think we're losing something of immense value, which is learning to reason our way to answers to questions. So the next time you get stuck on something, you already have the ammunition. You know as much about valuation at this point as I do. The only thing is, I mean, I'm about 1,000 companies ahead of you, and having tried this, learned the hard way, that didn't work. But try to reason your way to an answer, because in a sense, it's like any other muscle. You don't use it, it's going to go away. And I think increasingly we're losing the capacity to reason, because we're too busy reading what other people think or looking up what other people's answers are. So at least in intrinsic valuation, the answer often lies by going back and asking, what is the question I'm trying to address? So that's the last you'll hear from about intrinsic valuation, at least for the moment. So let me start on packet 2, because the rest of today is going to be pricing. That's the wrong one. Okay, so let's set the table. In intrinsic valuation, you try to value a company based on its cash flows, growth, and risk. In pricing, you're trying to estimate what to pay for something based on what other people are paying for similar things. So I'll start with a very simple example. My youngest son lives and works in New York, so we were going to go to opening day, Yankee Stadium, but he had to work. His employer, for whatever reason, insisted he work between 1 and 4 in the afternoon. No, he said he couldn't make it. So we said Sunday we'll do it. So 2 days later, and he still keeps college student hours, which means he goes to bed God only knows when. Wakes up. Weekdays he has to wake up to go to work, but weekends. So the game is a 1:30 game. I call him at 10, I call him at 11, and 11:30, 12, he's not picking up the phone. 2:30, he texts me saying, did you buy tickets to the evening game? And I said, what evening game? The game's happening right now. You slept all the way through it. She said, sorry, Dad, we could do it in a couple of weeks. So I bought tickets to I think it's I don't know who's coming. There's 2 weeks from now. Might be the Twins game. So the way I bought tickets is I went on SeatGeek. Now you're buying a ticket. You're saying, how much should I pay? SeatGeek makes life really simple. Have you ever used the site? SeatGeek is an aggregator site for sites like StubHub and other sites where you can buy tickets. The nice thing about SeatGeek is not only does it aggregate, it does your homework for you. So I wanted something at field level because it would be fun. So I got a field level seat. And I picked SeatGeek. Actually classifies deals from outstanding deals to horrific deals. I don't think they use the word horrific, but basically they classify them. You know what they do, right? They take the price per seat in each section. They compare to other people trying to sell seats in that section. And they compare the price that's being asked for a seat to the prices of other seats in the section. And if the price is much lower, you're getting I think awesome deal might be what they call it. I got an awesome deal. I got a $30 field level seat. This might be a complete, I haven't got confirmation, so maybe this is a ripoff, but SeatGeek will usually refund me if that is the case. $30 for a field level seat at Yankee Stadium. You can't even get bleacher seats for $30. That's an awesome price. How do I know? Because I can see what the prices around me are going for, and they're going for like $150. So either this person was drunk when they listed, or the seats don't exist, in which case, one way or the other, I'm going to find out. But the essence of pricing is, what do? You look at, first, you identify comparable assets, in this case, seats in the same section. I can't just compare seats across Yankee Stadium because a bleacher seat and a field level seat are different.
The seats are all the same. They're all uncomfortable blue plastic seats. But if you had cushion seats, and you might have to adjust for the seat size and the seat comfort. But usually then you have to standardize the price, and then you compare across. A first row seat is going to be worth more than a fifth row seat because you're right on the field.
That's pricing. We do it all the time. And in the context of stocks, it shows up as finding companies that you say are just like your company, standardizing the price there. So there usually means dividing the price by something, price by earnings, price by book, a multiple. And controlling for differences will be, why do some companies have higher PE ratios than others? Growth and risk and cash flows, all the things you were running away from in intrinsic valuation. So I'm going to start with a statement about pricing that I think I can back up. When I say that almost everything that passes for valuation out there is pricing, here's where I make that statement. About 20 years ago, I collected about 550 equity research reports from around the world. I confess I didn't read them. I collected them because I wanted to chronicle how equity research analysts put buy or sell recommendations. What did they do? So I'll summarize what I found. Out of the 550 equity research reports, 45 were intrinsic valuations. They did a DCF and they put a buy or a sell base. That's less than 10%. About 450 used a multiple and a comparable. They were making a pricing judgment. 10-1, pricing outnumbered intrinsic valuation. You think 450 plus 45 is 495. What about the other 55? I was completely mystified as what they were doing. Maybe they were using tarot cards and doing something, but I have no idea. But among the ones I could classify, 10-1, pricing outnumbers. If you don't believe me, walk into a Goldman Sachs or a Morgan Stanley, but they have all the equity research reports lined up. Pick up each one and read it, and you're going to see roughly the same statistic. Equity research is almost all pricing all the time. I thought it might be different in corporate finance. When you do acquisitions, you're buying a whole business. I assumed there'd be more discounted cash flow valuations. And on the surface, I was right. I actually got my hands on about 100 acquisition valuations. They're really difficult to get your hands on because you know what happens to them after they're actually used. They go into a shelf so that nobody can ever see the forecast you've used before. So it looked like almost 50-50. Half of these looked like they were discounted cash flow valuations until I took a closer look. And I discovered very quickly that they weren't DCFs, they were actually pricing in drag. Why? What's the biggest number in a DCF? The terminal value. And how does the terminal value estimated? Using a multiple of EBITDA or revenues. So even in M&A, it seems like pricing dominates. And almost every investing rule is based on some kind of a multiple, right? A PE ratio less than 10 is cheap. A price to book less than 1 is cheap. A PEG ratio less than 1. Everything is stated in terms of pricing metrics, not in terms of intrinsic valuation. So I think it's silly to argue against the idea that pricing is what most people use, even though they might go through the motions of discounted cash flow valuation. And that puzzled me a little bit when I first uncovered it. Because there's going to be an exit interview I do when you leave this class. You've already seen the question. You know, the question is going to ask you, right? You've spent 15 weeks or 14 weeks on, coming up with valuation approaches and pricing. I'm going to ask you a question. As you leave this class, and given the experiences you've had with both valuing your company and pricing your company, I know it might be a sample size of one. You've only done it with one company. If you had to pick right now, which one you trust more, which one you will base your decisions on, 7-2, people pick valuation over pricing. Reflecting my biases, I guess, you're reflecting. So when you leave my room, at least in theory, you're saying, I'm a true believer in intrinsic valuation. It's actually 70-20-10. 70% pick valuation, 20% pick pricing, 10% become believers in efficient markets. Or they actually discovered this isn't that easy. Maybe the market's not that stupid after all. I haven't done a follow-up interview 5 years later because many of these people go out and become equity research analysts, they become bankers, they become CFOs. But 5 years afterwards, I tracked these people down and asked them exactly the same question. Now that it's been 5 years since the class and you're doing this number, attaching numbers to assets still,
Which one are you using more? I'll wager the numbers get switched. Something seems to happen after you leave this class and when you start working that makes you go from being believers, true believers in intrinsic valuation, to everyday users of pricing. So I started thinking about what might be the reason. The first one came to me while I was watching a Seinfeld episode. You guys have all watched Seinfeld, right? Come on, say yes. If you live in New York, you have to watch it. This is a quintessential New York sitcom, right? So in this episode, one of Jerry's girlfriends accuses him of being crazy. Say, Jerry, you're crazy. He says, if you think I'm crazy, you should see the guy who lives across the hall from me. You know who lives across the hall from Jerry? A guy called Kramer. A guy who's so crazy that relative to him, everybody looks sane. You see why people like pricing? If you have to sell something, even if you're trying to sell something very expensive, all you have to do is show me something even more expensive. Say, look, it's cheap. 50 times revenues. No, the thing's selling for 100 times revenues. Your cholesterol is 350. Not a problem. Relative to people who've died of heart attacks in the last 2 years, you look okay. All I have to do is pick the right comparables, and I can pretty much spin you any story I want. We forget how much of valuation is selling, right? Because you don't value a company because you're intellectually curious. You're trying to sell it to somebody else, and it's easier to sell something with a price than it is with an intrinsic valuation. Second, when you do an intrinsic valuation, insights are out there for everybody to pick apart, right? So I could say, hey, why is your revenue growth so high? Remember the valuation you sent me? I said, why is your revenue growth so high? Why are your margins so high? Why is your discount rate so low? And you got to defend all these assumptions, even though some of them you might have completely made up. Why is your margin so high? I don't know. I've had in a good mood. I gave them a 35% margin. In contrast, if you told me I value this company at 12 times EBITDA because that's what the sector is pricing companies at. Think of how small the target is. You don't like 12 times EBITDA? Take it up with the market. In effect, in pricing, that's basically what I'm saying. It's not my fault. I am just the messenger here. Don't shoot the messenger. It's much easier to defend a pricing than it is to defend an intrinsic valuation. You've been to an IPO roadshow? So when bankers gather together, they go across the country and say, Uber is the greatest thing ever. You go to an IPO roadshow, the bankers, if they're sensible, will never use an intrinsic valuation. It'll all be about pricing and metrics to convince you that this is the greatest pricing ever. So it's easier to sell, it's easier to defend. And here's the coup de grace. I told you I'm a believer in intrinsic valuation, but even as a true believer, I think if I'm lucky, I'm right 57 times out of 100. Remember, you beat 50 times out of 100, you're doing significantly better than the market. But I'm going to be wrong about 43% of the time. With pricing, I think if I'm lucky, I might be right 51% of the time, even if I bring all the data and statistics. 57 beats 51, right? I'm right more often with intrinsic valuation, but here's the catch. When I'm wrong on intrinsic valuation, I'm far more likely to be wrong alone. You see why? Where will intrinsic value lead you? It'll lead you to companies that other people are fleeing from. You're a contrarian. You're buying when other people are selling. You're selling when other people are buying. So when you screw up, you're often screwing up alone. You know what happens to people who screw up alone? They get fired. First rule in screwing up, if you're going to screw up, make sure you have lots of company. You see why people are attracted to pricing? You look at people, so why did you buy those companies at 50 times earnings? Because everybody else was doing it. It's a very effective protection. That's why all those .com analysts in the late 90s stayed on as equity research analysts in the next decade, right? In any just world, Mary Meeker should never, ever be allowed into equity research ever again. But if you're doing pricing, your argument is everybody was doing it. When I first started teaching this class, I used to try to talk people out of pricing. I don't do that anymore because the reality is most of you will end up in jobs that require you to price things.
If you sit there saying, I will do only intrinsic valuation, you're either going to get fired or you're going to be the odd man out in that process. So what I'd like to do instead is talk a little bit about why, even if you're a true believer in valuation, you need to understand pricing and how to do it right. I'm a believer, as I said, in valuation, but I think it helps me when I value companies to know or understand the pricing process. Why? Because ultimately, how do I make money? When the price adjusts to value, right? So if I can understand why people are doing what they're doing, I might not agree with them. It might give me a basis for at least coming up with a way of saying, this is when I should buy a company when it's undervalued. Understanding why markets do things can be critical in how you value companies or when you act on those valuations. And if you're in a job where you're going to get judged against other people doing the same job, whether you like it or not, you got to be working on parallel paths. You got to buy undervalued companies, but you want to make sure that you're not ending up with the pricing judgment that works so badly against you that you will not survive to the next period. Ultimately, you might be right, but then it's too late. So let's talk about pricing stocks. To price stocks, as I said, you need to standardize prices. First, is everybody clear on why you need to standardize prices? Otherwise, Berkshire Hathaway is always the most expensive stock in the world, and any penny stock looks cheap. You can't look at the price per share. So every multiple is basically a standardized price. So let's set the table. When you look at a multiple and you look at the numerator will almost always, in fact, let me take the almost, will always have a market number in it. That market number can just be the market value of equity, market cap. It can be market value of equity plus market value of debt, which is total value of the firm. Or it can be market value of equity plus market value of debt minus cash, which is called enterprise value. They're all numbers which are market set. So the numerator is a market number. The denominator is your scalar, what you scale that number to. And let's look at the choices. You can scale market value to revenues. Why might you want to do that? Because you're desperate. You're comparing 50 money-losing companies. You can't do earnings. You can't do EBITDA. You keep climbing the income statement until you hit something positive. I found a positive number. It's my revenue. What if you have pre-revenue companies? You're in real trouble now, right? So then you look for something that might give you revenues, like what? Users, downloads. You're getting desperate, but you need a positive number in the denominator. If nothing else works, you say, I'll divide by the number of cars in the parking lot. You need a pricing metric scaled to something. So it could be revenues, it could be drivers of revenues. It could be earnings, right? The earnings can be to equity investors, which is net income, or it can be to all investors, which is operating income. It can be to cash flows. For equity, it can be net income plus depreciation, or if you want to get really fancy, even compute a free cash flow to equity for every company, which is subtract our net capex and change in working capital, bring in debt. Or if it's to the firm, you can compute free cash flow to the firm, but that's so much work. Remember, the reason people use pricing is why? Because they're lazy. They don't want to do all that work. Free cash flow to the firm, so many items. Give me a simpler. Now, do you see why EBITDA has become this ad hoc measure of free cash flow? It's kind of neither here nor there, but you take EBIT, you add DA, you say, got a cash flow. You can divide market values by what accountants think your company is worth. What does that mean? You can divide the by book value of equity, because that's what the accountant says your equity is worth. By invested capital, which is book value of equity plus book value of debt minus cash, or even book value of equity plus book value of debt, which you can think of as the book value of the firm. Revenues, earnings, cash flows, and book value. So when you look at multiples, first thing to do is, what are they doing? What's in the numerator? What's in the denominator? Get that kind of nailed down. So I'm going to take you through a 4-step process for using pricing. And if you're religious about following this process, and I'll confess, sometimes I'm in a hurry and I don't go through the process, I always regret it. First step in the process, I'm going to start by defining the multiple. Now, this is going to be mildly insulting, but hopefully you will absorb the insult and move on. So you're saying, if I said PE ratio, I'm going to define it. What's your reaction? I know what a PE ratio is. That's so simplistic. I'm going to challenge you on that. When you talk about PE and I'm talking about PE, are we talking about the same
price earnings ratio. So in the process, I'm going to set a couple of rules on multiples, on that they be consistently defined. I'll come back and explain what I mean by that. And uniformly estimated, which is actually easier to understand because you're going to compare 15 companies. You got to be estimating the same way for all 15 companies. You start with the definitional test. Second step, I'm going to describe the multiple. Sounds fancy, right? But I'm going to play Moneyball. You seen the movie? I'd strongly recommend it. One of my favorite movies of all time. And especially what's the part where Jonah Hill talks about what he plans to do, right? Because Moneyball is basically the story of Billy Beane, who's the general manager for the Oakland A's. He still is, even though he's never won a World Series, he's become a legend. And it's about how he deviated from the status quo. The status quo in baseball was you listen to scouts and they would have these rules of thumb. Does it sound familiar? In investing, do we have these equivalent people who give you rules of thumb? And finally, Billy B noticed that all these rules of thumb had long histories, but none of them worked. So a scout would say, this guy has a crooked arm. People with crooked arms are very good pitchers. Trust me, I know this. And after you signed paid $15 million to get this guy with a crooked arm, it turned out that he had some malfunction in his elbow, and his elbow blew up. So finally he said, why are we trusting these guys? They have no idea what they're talking about. And baseball is a sport more than any other sport that's built on data, right? Every pitch that gets pitched gets recorded, every hit every walk. So he said, why don't we just look at the data to see whether they're delivering the outcome we want, which is what in baseball, what's the end game? You have to score runs. He said, who cares what the scouts think? If a guy gets on base by walking all the time, guess what? He says just as good as somebody gets a base hit. And that's what Jonah Hill did. He went through the data and he basically got the Oakland A's to sign this guy called Kevin Youkilis, a guy I learned to hate as a Yankee fan when he was playing for the Red Sox. The God of walks is what he was called because he found a way to he had a very good eye and he managed to walk, 30% of the time. What I'm going to do is the equivalent of what you saw in the movie. We've been listening to scouts tell us rules of thumb in investing all this time, but we have this incredible amount of data in front of us. What was to play some Moneyball? And luckily, we don't need Jonah Hill to do this. We have the data, we have the statistics, and I'm going to play some Moneyball with each of the multiples we're talking about so you get a sense of perspective. What's high, what's low, what's typical, what's the average, what's the median. Third step in the process is I'm going to analyze the multiple. I'm going to take an intrinsic valuation model. I know we moved away from there. And I'm going to do some basic algebra and show you what the variables are that drive a PE ratio, price to book, a payout ratio in an intrinsic value world. You're saying, why am I going there? Not because you want to use the same equation, but because it tells you the variables you need to control for when you use that multiple to compare across companies. Define, describe, analyze. And only then am I going to apply. You know what the problem with pricing is? People are in such a hurry to apply a multiple, they don't want to go through the first three steps. So let's start with the first question. Look at a multiple. First question I ask is it consistently defined? Let me explain what the test is. Remember I said every multiple has a numerator and a denominator? Here's a simple rule. If the numerator is an equity value, the denominator has to be an equity value too. If the numerator is a firm or an enterprise value, the denominator has to be a firm or an enterprise value as well. You have no idea what I'm talking about, right? Let me pick a multiple. Price earnings ratio. What's in the numerator? Equity value, firm value, enterprise value. Equity value, price per share, market cap. Earnings per share. Equity value, firm value, enterprise value. Equity earnings. Thank God for small blessings. The most widely used multiple in the world is okay. PE ratios are okay. What about EV to EBITDA? What's in the numerator? Market value of the operating asset. That's basically what you're supposed to be getting with enterprise value. In the denominator, you have a measure of operating cash flow, a very rough pre-tax, pre-capex measure. EV to EBITDA is okay as well. What about price to EBITDA? It's a horrific multiple.
The analysts who invented this should be tarred, feathered, and driven out of the fraternity if one existed. You know, Bloomberg used to report a price to EBITDA for every company. I pointed out that this was a horrific, I might have used exactly that word. It seems to have disappeared now. But if I went back to those 550 equity research reports, 10 of them use price to EBITDA as the metric. One of them happened to be somebody who'd gone through this class a few years earlier. So I called the guy. And he said, remember the valuation class you took a few years ago? He said, vaguely. I said, it shows. I said, what the heck are you doing? Dividing price by EBITDA. It's not consistent. He said, no, I'm being consistent. So what do you mean you're being consistent? He said, I use price to EBITDA for all 15 companies in my sector. I said, it's a very strange definition of consistency. I said, have you been noticing that companies with a lot of debt in your sector keep looking cheap to you? He said, yeah. But I said, have you ever stopped and wondered why that might be happening? Do you see why when you use price to EBITDA, heavily levered companies are always going to look cheaper? Because what's in the numerator? Market cap, just the equity portion. So if I borrow money and buy back stock and reduce my equity, my numerator goes down. But in my denominator is earnings before interest, taxes, depreciation, amortization. That's going to stay the same as I borrow money. Before you feel too superior to this guy, if you ever use price to sales, you're guilty of the same sin, right? Market cap and revenues. You know why people get away with it? What are the sectors or sector where you see price to sales used the most? Technology. And why do you get away with it? Because they tend not to have debt. You got lucky. Okay. The other is retail, and even there it's shaky. Now it used to work because everybody had they all had lease commitments, they all had debt. Mismatch is a recipe for disaster. So that's the first stop, is make sure your multiple is consistently defined. Second, it's got to be uniformly estimated. If you're going to compare this across 15 companies, let's say it's PE ratios, earnings per share should be estimated the same way for all 15. I used to think this was a slam dunk in markets like the US because you had one set of accounting principles, right? It's GAAP. And what we've discovered, especially over the last 2 decades, is you can have the same accounting rules govern 20 companies, but different degrees of fidelity to those rules. In other words, you don't even have to break the rule. You can push the limits of the rule. And if you're conservative as a company, you report lower earnings. And if you're aggressive using the same rules, you can report higher earnings. Which is one reason about 15 years ago, S&P actually created a database where they take reported earnings and actually clean up for items that they felt were being miscategorized to try to come up with consistent earnings. They gave up on it. The demand was just not there. But there's this company called New Construct. If you get a chance, they're online. They actually try to do this with companies. It's clean up earnings so we get a number that's actually comparable across companies. Is it consistently defined? Is it uniformly estimated? So let's try this on a few multiples. So PE ratio, most widely used multiple in the world. Everybody knows how to compute a PE ratio. Even Anna Kournikova seemed to know. Remember Anna Kournikova? Most of you don't remember her. She masqueraded as a tennis player for like 10 years. She was Russian tennis. Why masquerade? She never won anything, but she was on every commercial. She was like a Maria Sharapova without the talent. So this is in 2001 or 2002. There's a Charles Schwab commercial. Charles Schwab commercial, Anna Kournikova is playing somebody, must have been an actress. She was actually winning. In tennis, every 2 games, you got to switch sides because you don't want the sun in your eye, wrong side of the court. So they're switching sides in the middle of the match. For whatever reason, Anna turns to whoever she's playing and says, price earnings ratio is price divided by earnings per share. Why this would come up in the middle of a tennis match, I don't know. But I remember turning the TV off saying, is that all it is? Does Anna Kournikova really know what the PE rate? She kept going. She said something about preferred dividends. It went completely over my head. And I said, Anna Kournikova, let's break it apart. What's in the numerator of the PE ratio? Usually the price per share, unless you've got one of those technical analysts gone crazy. You know what they like to do? They like to smooth out everything. They take an average price across time. To which my response is, have you ever tried buying a stock at a moving average price? It never works. Numerator is usually the current price. It's in the denominator that you get the variations, right? I divide by earnings per share, but the earnings per share can be from the most recent fiscal year, which is called current PE. It can be earnings per share from the most recent 4 quarters, which is called trailing PE. It can be earnings per share from the next 4 quarters, which would be forward PE, or it could be earnings per share from the year 2030, which is really, really forward PE. So why would I do that? Desperation again. You're the biotech analyst, you've got 35 companies in your sector, 33 are losing money, and PE ratio is the only tool you know how to use. Guess what you do? You project out the earnings for every company. And you say, this company is cheap, it's trading at 8 times 2030 earnings. You say, what? What am I supposed to do with it? But before you can even think through, you bought the stock because 8 sounds low, right? Remember, the more forward you go, the lower the number is going to get because you're dividing the price today by an earnings per share in a future year. It can be earnings before extraordinary items, after extraordinary items. It can be earnings before stock-based compensation, after stock-based. You see where I'm going, right? I remember about 7 years ago, I sat down with Cisco, widely followed stock. Estimated 34 different PE ratios for the company at one point in time, depending on different definitions of earnings per share, ranging from, I think, 14 at the low to 60 at the high. Which one am I going to use? Depends on what I'm trying to do. If I'm trying to sell you Cisco, guess which number I latch on to? Cisco is cheap. It trades at 14 times earnings. If I want to show you Cisco is expensive, the next time you see it, this is one of the funniest things to see on CNBC, is 2 analysts with differing views of a stock, both using price earnings ratios, but they can't even agree what the PE ratio is. The bullish analysts always use forward earnings, and the bearish analysts use trailing earnings. Not that one is right and the other is wrong, but because it serves their story better. So PE ratios are consistent, but you can see variations. But there's one aspect of PE ratios where I think life has become a lot more difficult over the last 40 years. How do you get earnings per share? You take net income and divide by share count, right? But think about what's happened as companies increasingly have gone to stock-based compensation. You have a primary share count, and then you have a partially diluted share count where you count only options if they're in the money, or a fully diluted share count where you count in all options. Your earnings per share are obviously going to be different with each definition. So let's say you're looking at a sector where there's big variations in how much stock-based compensation gets used by different companies. And let's say they use options. Are any of those 3 approaches, or let me rephrase it. With each of those 3 approaches, am I going to get biases? Let's start with primary earnings per share. If I use PE, where I divide by the actual number of shares and I'm ignoring all the options that are out there, and I'm comparing across companies, what kinds of companies are going to look cheap to me? Companies with a lot of options outstanding or not very many? And tell me why. When you have a lot of options, what's the market doing? In other words, the market cap reflects the fact that I have tens of millions of options, so it's going to be lower, but because I'm dividing by the primary earnings per share, the stock is going to look cheap because I'm not factoring in the reality that there are 100 million options overhanging. So with primary earnings per share, I'm going to bias myself against companies which have very few options and towards companies. If I use fully diluted earnings, I'm going to go in the other direction. I'm counting all these options. Some in the money, some out of the money. I'm counting as if they're all shares. I'm going to bias myself towards companies that have no options at all. And with partially diluted, I fall somewhere in the middle. So none of these really are going to, but we do this all the time, right? So if I wanted to get a truly consistent measure of PE ratio for technology companies, and I worry about these options outstanding, what should I really be doing if my end game was to get a PE ratio that actually meant something? So using the market cap as share price times number of shares, you know what I should be doing? I should be taking share price times number of shares to get market cap, but all those options have an equity value, right? Can we estimate what that equity value is? You did it for quiz too. What did you do? Attach an option pricing model? It'll never happen. Trust me, this will never happen. It's too much work. No analyst is ever going to do it. But if you truly wanted something that was comparable across companies, we should be using not the market cap, but the market cap plus
the value of the equity options outstanding and including all the restricted stock, because that is the true value of equity. Let's talk about EV to EBITDA. Anybody here from an equity research background? No?
I did over the summer.
Okay. And what sector did you work in?
US machinery.
Did you use EV to EBITDA?
Yes. But
Okay.
what's the price to
I'm going to let you be the arbiter of EV to EBITDA here, because trust me, you will be able to answer the question if you think about what you're trying to do. So what's EV to EBITDA? It's market value of equity plus debt. It's supposed to be market value of debt, but what do we usually do? We use book value, which we get away with until we run into a problem with distressed companies. But in theory, it should be market value of debt minus cash. Right? We use net debt. So I've asked this question of hundreds of analysts who use EV to EBITDA. I seldom get the right answer. Maybe you can give me what the answer is. Why do we net cash out of the numerator?
Cash already has a value, and we don't need to value that we need to take it out.
So what if let's suppose one of your assets is a certain, should I take out the value of every asset where I feel pretty certain about the value then?
That's just 1-to-1. There is no risk associated.
You see, I don't think even you are convinced with your own reasoning, right? Because ultimately I still get the cash. I buy Apple, whether it's certain or not, it belongs to me and it looks like I'm not counting it. I'll give you a clue. What did we say? Consistency, right? Look at the denominator. What's in the denominator? EBITDA. Where does the interest income from cash show up?
Interest income from cash below EBITDA.
There's your answer, right? Because my denominator does not include the income from cash, I have to take it out of the numerator. And I've opened a Pandora's box. In addition to netting out cash, what else do I need to be net out of the numerator? What other assets do companies own whose income doesn't show up as part of EBITDA? Or cross holdings in other companies? You see how when I look at a Tata Motors and I'm getting 30% of my value, if I'm doing enterprise value to EBITDA right now on consistent answers, I need to be netting out cash and I'm going to be netting out minority holdings. Never majority holdings, God help me, because now I have a real problem, right? My EBITDA is a consolidated EBITDA where I counted 100% of the subsidiary, but I own only 60%. So to get consistency, you know what I need to do? I need to bring in the 40% into the numerator that doesn't belong to me, just to be consistent. And how do most analysts do it? They add the minority interest to the numerator. And the reason it's half-assed is minority interest is book value, right? So they're taking a book value minority interest and adding it to cash. So basically their reasoning is good. But you can already see that getting consistency with EV to EBITDA means dealing with cross-holdings. So if you were running away from intrinsic valuation because that cross-holding section freaked you out, guess what? It's chasing you down when you're doing pricing. It's always going to be something you deal with. One final question about consistency. And this is actually an interesting question about how do you detect if there's a bubble in housing, right? Because most housing, you know, it's very difficult to tell when there's a bubble. So I'll tell you one metric that people look at. They look at what you pay for a house and they look at what you make as rental income and they look for mismatches. But let's suppose you're trying to decide whether to invest your money in equities in the stock market and housing, and you're trying to come up with something that, you know, so you've taken the house price and you're dividing by rent to come up with the ratio for housing. What is the equivalent multiple I'd look at in the equity market to decide whether equity was cheaper or more expensive? So you're trying to be consistent. So I'm taking the housing price and dividing by rental income. First, housing price, is it closer to market cap or is it closer to enterprise value? Did you pay for the entire house? Usually not, right? You borrowed money, but I'm counting the entire housing price. So it is an enterprise, it's closer to an enterprise value. And then the denominator becomes, what is rental income like? It's like, is it like revenue? Is it like operating income? It's probably revenue, but the expenses you have are, you know, are really the operating expenses you have are small. You can't count interest expense because that will make it into an equity income. So if you think about maintenance expenses, maybe that'll take, I think you could probably get away using an enterprise value to revenue multiple as your comparison. But if you really wanted to say this is really operating income and you want to go with EV to EBIT, I can live with that as well. But my point is, you want to compare across asset classes. You have to think about, am I comparing apples to apples? Because otherwise I can come up with the wrong conclusions about an asset class. So I'd let you think about it. If I have housing price to rental income, rental income would be what I make if I rented this house out. What is the analogy I would use in the equity market to make a comparison as to whether equities are cheaper than housing? And maybe I'll try it out in the S&P 500 using what I know about housing price and rental income now. But it'll be an interesting comparison to see across assets. So definitional test. Let's move on to the descriptive test. When you look at PE ratios. Now, 60 years ago, if I asked you, what do the PE ratios look like across the sector? It was a huge amount of work, right? You had to go collect the PE. I know I've been nagging you about S&P Capital IQ all through, and many of you have never accessed it. And to value an individual company, you really don't need it that much, right? Because what you depend on are financial statements. But when you do pricing, having access to a database like S&P Capital IQ becomes immensely useful. Because I can now pull up the PE ratios for not just every company in your sector in this market, but across the globe. I can pull back PE ratios for the last 20 years for every company. The data is there. But when you look at data, you can't just look at 60 companies over 20 years. You got to compress the data, summarize the data. So start with the standard summary statistic. What's the average? What's the standard deviation? But this is where having distributions can help you. Drawing a distribution, because that makes you think, is it symmetric? Is it asymmetric? Is it normal? Is it abnormal? Because that'll tell you a lot more about how this multiple. You're not interested for statistical reasons. It's about how do I use this multiple. So as I said, one of the things I do in the first week of the year when I collect data on every publicly traded company is I compute every conceivable multiple I can for every company. PE ratio, price to book, EV to EBITDA, EV to sales. The data is already, that looks like a lot of work, but once I've got I don't actually use Capital IQ's PE ratios, price to book, EV to EBITDA, EV to sales. You know why? Not because they're necessarily wrong, but I don't know what they're doing with cross holdings. I don't know what they're doing with goodwill. I don't know what they're including in earnings per share. So I want to make sure that I control the numerator and the denominator. And my advice to you is, when you're going to compute multiples, do it yourself. This is one number divided by another number. Why do you have to have Capital IQ do it for you? It doesn't save you any time. So download the market cap and the net income of every company and do your own PE ratio. It might match up or might not match up, but at least you know what goes into your multiple. So this is what the distribution of PE ratios look like for US companies at the start of 2023. So remember what I said about asymmetry? You look at the distribution, you can see exactly what I'm talking about. Peak to the left, tail to the right. Why? Because the PE ratio cannot be lower than 0. It can potentially be a very high number. In fact, I've arbitrarily made the tail less because I've said everything above 100, but if I kept going, it would keep going. And to show you how this plays out in terms of statistics, here's what the numbers look like when I computed the summary statistics. First, let me start at the top line. There were 7,165 companies in my sample. That's every publicly traded company in the US. But I seem to have lost about 4,000 companies in just computing PE ratio. What happened? There were negative earnings. You say, 2022 must have been a terrible year. 2022 was not, it was actually pretty, this happens every single year. I've been doing this since 1992. I lose about 60% of my sample every year. Some years like 2009 can be up as high as 70% because you have money losing companies. You think, so what? I still have 3,000 companies. Is there a potential bias that you get when you remove companies in your sample? What kinds of companies am I losing? Probably younger companies, risky companies, smaller companies. Something to think about. When you see an average computed across PE ratios, those are the PE average across the companies that actually survive and have earnings. That might not be the PE ratio you want to report for the sector because there are all these other companies. I've struggled with this for the last 30 years because I compute averages by sector. And when I first started doing this, I used to compute the average across the companies that had PE ratios. And I very quickly realized that I was getting numbers that didn't capture. So if I took biotechnology, I had 35 companies and only 3 of them had made money. I computed the average PE across the 3 companies, and that doesn't make any sense, right? So is there a way out of this? Is there, because clearly you don't want to create biased averages. So maybe you can give me a better way of doing this. I'll tell you what I do, but maybe I'll open up for suggestions. How do you deal with this loss of sample of bias that comes from the fact that I'm throwing out money-losing companies? There are 2 ways, at least, I can think of doing it. See if you can come up with a third way, or maybe one of the 2. Want to try? I'm sorry? But I still need a positive number in the denominator, right? So even if I don't see how that would solve the problem in terms of bringing because basically I want to get the information, the 32 companies that I threw out to not leave the data, because there is information there. I'll tell you what I do. I add up the market cap of every company in the sector. I add up the net income of every company in the sector, including the money-losing companies. I take the aggregated market cap by the aggregated net income. It's like a weighted average of the PE ratios, but it includes the companies that are money-losing in there. Yeah.
What if you average the earnings you enjoy?
That is the other response, because the reason PE ratios you have to throw at negative earnings companies is as a continuum, right? What's a continuum? Low PE ratios is better as for an investor than a high PE ratio, right? But when your PE ratios become negative, they're actually more like very high PE ratios. So the problem with PE ratios is because that continuum gets broken, you have to throw out negative earnings companies. But if you use earnings to price ratios, nothing stops you from having a negative earnings to price ratio. That's worse than having a positive earnings to price ratio. And essentially you get a continuum that works. So one reason for using earnings yields instead of PE ratios is you no longer have to throw away money-losing companies. So those are the 2 that I've come up with. But if you can come up with a creative third way of not throwing away money-losing companies, I'd be interested in learning, because it's something every start of every year I realize, well, is there a better way of doing this? No. I do report the median PE of the companies that have PE ratios, but I also report the aggregated number, because I think that has more value thinking about how our sector is being priced. My average PE for US companies at the start of 2023 was 109.25. It's mind-boggling, right? But before it freaks you out, the median PE at the start of 2023 was 13.92. What does that mean? Half of all companies with PE ratios trade at less than 13.92. You see, that's a huge difference between the average and the median. And the culprit is right here. There's actually one company, the PE ratio of 0.05. You know what probably happened to it, right? The earnings still reflects the trailing 12-month earnings, and you have the Silicon Valley Bank kind of collapse in the price. The price today has gone to almost 0, but the earnings are still kind of lagging. So don't go out there and put all your money in the 0.05 PE and that's an incredible bargain. My guess is this is the calm before the storm, before the whole company blows up. There's the highest PE ratio, 86,400. Incidentally, as I go from current PE to trailing PE, and remember when I did this, there was a divergence, right? Current PE I computed at the start of January 2023 was based upon probably 2021 numbers, because that was the most recent year. And the trailing PE was through September of 2022. For most of you, current and trailing PE are going to converge. There's this moment of grace at the start of the year, probably March, April, when current and trailing PE converge. And then they will diverge again. So trailing PE, I have about 3,097, almost the same as current PE. But then when I go to forward PE, I lose another 600 companies. Why? With the extra 600 companies being lost. What do I need for forward PE? I need next year's earnings per share. There's no way I'm estimating earnings per share for 7,165 companies. So you know what I look for? An analyst estimate of earnings per share next year, which Capital IQ gives, but only for those companies that are
followed by analysts. We create bias in the strangest ways by the choices we make. So when you use forward PEs, whether you like it or not, you're already looking at a subset of your companies. Perhaps it's a subset you want to look at, but perhaps it's not. So when you talk about description, that's basically what you're looking for, is what can I learn from the data? So until about 2004, I used to do this just for US companies. Not because I was parochial, but because the raw data I had actually came from value line. I didn't have, there's no capital IQ, there was no. And I did just US companies. And in 2005, I started using Bloomberg. Terrible to get data from because it's not structured for research, to get data for other companies. And the reason I did that is I got sick and tired of taking this graph that I had from the US to Sao Paulo or Mumbai, and some grizzled analyst would put up his hand and say, it doesn't look anything like that here. I said, anything like what, where? I don't think Brazilian stocks have this tail to the right and peak to the left. He said, how do you know? Gut feeling. So I don't trust your gut. So in 2005, I decided to check their gut. So I started doing this across all companies. So today I do this for 47,000 publicly traded companies. And I create this chart simply again to get perspective. So basically in this, I have a chart for three groups of companies: US companies, emerging market companies, global companies. So if you look at those three charts, what jumps out at you? They all look peak to the left, tail to the right, right? Doesn't mean everybody has the same P ratio. So break down P ratios by region. And I want you to look at those P ratios and tell me whether there's things you can learn about. If I am a naive analyst and say, I'm going to go where the P ratio is lowest, you know where all my money is going? Oh, Eastern Europe and Russia looks really cheap. Maybe Canadians, don't ask me why. Canadian stocks. So if you look at those two, one you're surprised by, right? Canadian stocks. The other you shouldn't be. Eastern Europe and Russia have low P ratios. Why? It's risk. It's incredibly risky. Canada, who knows? Those Canadians do strange things. But it's actually, I'll tell you what the reason was. It's natural resource companies. And after really good years, Canadian stocks have really low P ratios because the market prices these companies on cycles. In fact, if you look at price to book ratios, you see the same kind of phenomenon. Look at the median. The markets that have the lowest price to book, or the regions that have the lowest price to book ratios, are mostly Latin America. They're mostly emerging markets, Africa, Eastern Europe. There's again one new market that you don't expect to see, the Japanese stocks. Japanese stocks for the last 30 years have always had among the lowest price to book ratios of any group. And it's not because they're cheap. It's because Japanese accounting allows for all these provisions to get built up, which pushes up book value. It's an accounting effect that's playing. So it's actually interesting to look at multiples across, because in today's day and age, we're often comparing PE ratios to Japanese companies, to US companies. If you're casual about it, you might decide, a price to book ratios, you might decide to buy a Japanese stock thinking it's cheap without factoring in the accounting reasons why it looks cheap. And finally, one reason I like to have these distributions play Moneyball is I get sick and tired of rules of thumb. 6 times EBITDA is cheap. You know how many times I've been told that when I'm in a panel? I now refuse to be on panels. It's mind-numbing to be on a panel sometimes. The PE guys say, oh, what is this DCF stuff you do? We know how to find a cheap stock. It's 6 times EBITDA. Okay. How do you come up with that? Maybe some drunk guy in the late 70s leaving his Wall Street office saying, you know what, from this day on, 6 times EBITDA is cheap, and it gets passed on generation to generation. So here's the simplest way to push back against rules of thumb. I remember in 2010, somebody came into my office, in 2011, came to my office, 6 times EBITDA is cheap. I said, wait just a moment, I have to do something. It turned in, and I did a histogram. I actually had the histogram. What the histogram looked like for EV to EBITDA for US companies. Half of all US companies traded at less than 6 times EBITDA. How can it be cheap if half of all companies do it? Could 6 times EBITDA be cheap? In 2023, unless you happen to be in Japan,
Do you see where I'm going? Having these absolute rules of thumb is kind of absurd because the numbers change underneath year to year. They change across markets. So if you wanted to create a rule of thumb that was actually data-centric, rather than pick 6 times EBITDA, if you want to stay with the data and say, I want to find cheap stocks, what should you define as cheap? Pick a percentile, 20th percentile, 25th percentile. And say, that's my measure of cheap, is I'm going to look at the first quartile, any company that trades at less than. So in 2023, if you ask me what's cheap, I'm going to look at the 25th percentile. And you can see that what's cheap actually varies widely across markets, depending on what part of the world you're in. I can understand the 1970s drunk guy making up 6 times EBITDA. He didn't have the data. He didn't have the data to look at. Today, we have no excuse. But think of how we still hang on with rules of thumb that have lost their entire basis because it's become conventional wisdom. Peg ratio less than 1 is cheap. No, that's, again, widely used practice. Actually, and I'll show you the graph of peg ratios very quickly because that doesn't look cheap to me. So define, describe. Next session, when we start, I'm going to give you a very simple device to analyze a multiple. We can look behind. Now think of it as lifting the hood of a car and looking at what the engine looks like. You're looking at the inside of a multiple. And you're doing it not because you care about the air, but because you know what questions to ask. When it stops working, when something looks cheap, you know what questions to ask. So next session, when we start, I'm going to give you a trick you can use to come up with those questions and variables and use them then on actual PE ratios to see if we can detect when something is really cheap as opposed to just looking cheap. So I will see you on Monday.